Welcome to SciFlux. Here, you get daily coverage of the latest scientific research. Every day we bring you new research in a clear and simple format, so you can stay informed without wasting time. Like the video, subscribe, and leave a comment to stay connected and help this channel grow. And, if you want each new research delivered directly to you, join the SciFlux newsletter. The first paper brings a powerful idea. What if land ownership were as secure as digital currency? That's the promise of blockchain, and this study looks at what it could mean for South Africa. South Africa's land registry works, but it's still mostly manual. That leaves space for errors, disputes, and even fraud. Blockchain changes the equation by offering a decentralized, transparent, tamper-proof ledger where property records can't be altered or duplicated. The researchers reviewed global evidence and identified 6 major economic benefits. Blockchain can strengthen economic stability, boost investor confidence, cut down on expensive legal disputes, improve tax collection, lower transaction costs, and stop double selling of properties. The result for South Africa? Faster and cheaper property transfers, more secure ownership, and government resources freed for other priorities. In short, adopting blockchain for land management isn't just tech innovation, it's a strategic move toward a fairer, more efficient, and more trusted property system. Next paper brings a powerful insight into global finance. For decades, Libor shaped trillions in loans worldwide until manipulation scandals forced its phase out. But even after its discontinuation, predicting this interbank borrowing cost remained extremely difficult because interest rates move in complex, nonlinear ways that often defeat traditional models. This study approached the problem differently. Researchers used artificial intelligence, specifically a multi-layer Perceptron model, to forecast the 1-month Libor using the US FED policy rate as the main input. And the result is remarkably clear. The model uncovered an almost perfect one-to-one relationship between LIBOR and the FED rate. When the FED moves, LIBOR mirrors it with extraordinary precision. This finding goes beyond correlation. It means that forecasting future FED decisions is essentially the key to predicting interbank borrowing costs. More importantly, it shows that AI, especially models like MLP, can capture deep financial patterns that traditional econometrics often miss. A strong reminder that the future of financial forecasting will rely heavily on intelligent, adaptive models capable of decoding the real dynamics behind global markets. Next paper explores how companies communicate with the market and how investors react to those messages. Researchers reviewed 181 studies, published over the last 20 years, to map out the full landscape of financial communication. They found clear patterns. Corporate governance and sustainability reporting are becoming dominant themes. When companies issue clear and accessible disclosures, investors make decisions more efficiently. But when disclosures are dense or overly complex, perceived risk increases and investor confidence drops. The review also highlights how technology is reshaping the field. AI tools are increasingly used in analyzing disclosures and generating communication, and ESG reporting has become a central influence on investor behavior. However, research is uneven across regions, showing the need for broader global analysis. Overall, this study delivers the first comprehensive overview of financial communication research. It identifies where the field is strong, where the gaps remain, and calls for deeper work on regulation, technology, and the psychological factors that shape how markets interpret corporate messages. Next paper looks at global CSR performance and how institutions shape it. Here's the 1-minute script. Next paper examines how corporate social responsibility actually plays out worldwide, The researchers analyzed 2023 data from 132 countries to understand how national institutions influence CSR outcomes across advanced, developing, and emerging economies. The findings show two distinct patterns. In developed countries, CSR performance is shaped by a broad mix of institutional factors: financial markets, social capital, regulatory quality, and other structural strengths. But in developing and emerging economies, the real driver is the combination of strong state institutions and a solid, functioning financial system. Across all regions, one factor is becoming universally decisive: political institutions that prioritize accountability and participation. The study also highlights a key insight: state-led CSR only works when governance is credible, stable, and trusted. Overall, this research corrects long-standing biases toward developed economies and shows that democratic governance and robust state capacity are critical for turning CSR commitments into real, measurable corporate action worldwide. As global economies confront mounting demographic pressures, China offers one of the clearest case studies of what lies ahead. China, a global economic powerhouse, faces a looming demographic challenge: a rapidly aging population, which often leads to fewer working-age individuals, more dependence, and a potential slowdown in economic growth. To understand the true causal impact, a recent study meticulously analyzed data across China's provinces over a 10-year period. Its findings are stark. A 10% increase in the proportion of the population over 60 years old decreases nominal GDP per capita by approximately 7%. This demographic shift has already constrained China's economic performance throughout the 2010s and 2020s and will continue to do so. While authorities are responding with policies such as increasing retirement ages and expanding childcare subsidies, the research shows that aging affects sectors unevenly, strengthening services while weakening construction. Understanding these dynamics is essential as countries worldwide navigate the long-term economic consequences of aging populations. Next paper talks about the hidden threats in the financial world, where cyber fraud constantly evolves and challenges security measures. Researchers in India aim to quantify its scale and trace its patterns across states, analyzing 2 decades of state-level data from 2003 to 2023. They used advanced regression techniques to understand how different fraud types contribute to the overall problem. Their findings showed that all major fraud types significantly impact incidents, with credit card fraud having the strongest influence, followed by internet banking and ATM/debit card scams. Importantly, these relationships change over time, highlighting the evolving nature of financial cyber threats. These insights equip policymakers to design targeted interventions and awareness campaigns to better protect citizens from digital fraud. Next paper talks about the hidden forces shaping company value in China's NEEQ market. Researchers studied whether implementing market maker rules could boost firm market value and how. Using data from over 13,000 firm years between 2006 and 2020, they found these rules significantly increased firm value, mainly through better stock liquidity, more investment in technology R&D, and higher government subsidies. Interestingly, the effects varied. Market-making trades benefited small, state-owned or base-tier firms most, while call auction trades helped larger innovation-tier companies. This study highlights that carefully choosing and even combining trading mechanisms can be a powerful strategy to optimize firm value and guide market design. This important study explores how foreign investment shapes a nation's services trade. Researchers analyzed FDI across manufacturing, services, and subsectors, like financial and non-financial services, from 1990 to 2019, assessing its impact on services exports across different income levels. Their analysis revealed a consistently positive link between services FDI and services exports. Specifically, financial services FDI drives exports in upper middle and high income countries, while non-financial services FDI is more influential in lower income economies, with manufacturing FDI also contributing to export growth. These insights provide policymakers with income-sensitive guidance to strategically leverage FDI for expanding their services sectors. At last, we turn to a study examining Nigeria's persistent debt challenge and its impact on economic growth. Researchers analyzed 34 years of data from 1990 to 2023, using the RDL model to assess short and long-term effects of external debt, debt servicing, and institutional quality. Their findings reveal that external debt and high debt servicing obligations significantly hinder growth, often consuming over 90% of federal revenue, while strong institutions can mitigate these negative effects. The study underscores that sustainable economic progress requires strategic borrowing, improved domestic revenue mobilization, and robust governance to transform debt from a burden into a growth-enabling tool. Thanks for watching. If you enjoyed the video, please like, comment, and subscribe. Also, join our newsletter to stay informed with the latest discoveries shaping science and innovation. See you tomorrow with a new round of breakthroughs. Take care.